Are we making money on any of our clients and projects? And is our team busy enough? When do we need to hire? And all of these kinds of important conversations.
Let's take a bunch of money, make a bunch of money, and then who cares if we're profitable? Whereas the agency landscape's different.
And the only difference there is instead of giving you a price for the deliverable, so I'm tying the price directly to the thing that you're getting, I'm now tying it to the outcome. The thing that nobody's talking about, but
Hello, welcome to B2B Revenue Leaders. Today I'm joined by Marcel Petitpas, who is the co-founder of Parakeeto. Marcel, welcome to the show.
Thanks for having me, Dustin. It's great to be here.
Yeah, we're going to talk about, it's interesting. I come from a SaaS background. I'm in the agency world now. So we're going to talk about agency profitability and pricing. But before we do, I'd love to hear just a quick background about you and Parakeeto and kind of why you specialize in this.
Yeah, it's a great question. Like most people, my first business ever was a service-based business. We were doing virtual reality services for real estate agents. So before you could do it with your iPhone, right? We go in with a DSLR, we'd take a bazillion pictures, turn them into 3D models and create 3D images of houses. And we had terrible margins because as it turns out, real estate agents don't love spending a whole bunch of money on their listings, especially not when it's a buyer's market and the houses are going to sit there for 2 years regardless. And so I became really familiar with this problem of really deeply understanding the unit economics of a service business when I first ran one. And so that's where I kind of got acquainted with the problem. I then got interested in software, like you spent a lot of time in the SaaS world. And then a friend of mine who ran a software development agency called me up one day and said, "Hey, dude, I spend like a couple days a week in spreadsheets trying to answer all these important and simple, but actually quite nuanced questions to run my business. Like, are we making money on any of our clients and projects? And is our team busy enough? When do we need to hire?" And all of these kinds of important conversations, but that are a little bit complicated because they connect people and projects and time and finance together. So he said, there's got to be a better way to do this. I totally resonated with the problem. And that is kind of what got us involved in Parakeeto, which was about 6 years now. So since then, we've been solely focused on this problem of helping agencies, consulting firms, do a better job of measuring their profitability and then, of course, improving it through that measurement.
Yeah, absolutely. I mean, coming from, I worked at SaaS, as I said, for a long time, profitability was kind of on the backseat. It was, let's take a bunch of money, make a bunch of money, and then who cares if we're profitable? Whereas the agency landscape's different. But I do want, you mentioned, you started out, I would imagine not quite freelance, but, you and maybe one other person, and then you grew that agency. So I think that's where a lot of founders struggle on the agency side. They can kind of balance the profitability, make a little bit of money doing it on their own, but it's when they start adding things, they add it too quick. So what are some of those common pitfalls you see as an agency grows?
Well, the biggest one that I'm going to speak to today, and hopefully we'll be able to address in pricing for those that are maybe in that position now where you're still kind of doing a lot of the work, but you have an aspiration to build a business, is that they just don't have enough margin in their service offering. And what's dangerous about early on is you have to create a theoretical cost in order to build enough margin in to support that next version of the business, which involves other people doing the work that's not you. And the easy trap to fall into is you're not counting the cost of all the time that you spend as the founder. And so you actually don't have unit economics that are scalable in your business. And that sucks because when you finally do end up in a place where you have so much work coming in that you're like, oh shit, I need to hire people, and you realize you can't afford it. So now you have two really hard problems to solve, right? Problem number one is I need to start charging more money and increasing my prices and cycling out all these clients that aren't paying enough and replacing them with clients that are paying enough. And then you also have this other non-trivial challenge of building a team, which is hard enough as it is, right? So hopefully what we talk about today can help people avoid the first half of that and actually plan to have enough margin in their service offering from day one, and then make sure that they're always planning for enough margin, even as they build a team and their cost structures change. They'll know how to think about that in a way that sets them up to have enough oxygen basically in the business so that money is not the constraint to them growing. It's all the other things that are hard about growing, which are non-trivial, but at least they'll be simpler if the money's there.
Yeah, I think one of the tricky things there too is the early stages, you're kind of just trying to get any client you possibly can. So everything has its own scope. Nothing is standardized or productized. And you're kind of flying by the seat of your pants and you can sort of make it work. But you're right. As you start adding people, there does have to be a bit of productization, I think, to actually get it to the point where it's consistent. Or at least, not everything can be a bespoke project. Is that fair to say?
I actually wouldn't say that. It's most important that you have consistent margins, but that doesn't actually mean that the work needs to be consistent. And this is where we get into the nuance of pricing model design, because the reality is you have a lot of big consulting firms that do hundreds of millions of dollars in revenue, and everything they do is completely bespoke every single time, and it's super technical, right? So let's take like an engineering firm, for example. It's like, well, if the city of Chicago or actually a better example would be Baltimore. Baltimore needs a new bridge, right? So they're going to hire an engineering firm to say, we need you to design this new bridge. Well, that bridge is going to be unique because that's a completely bespoke project. So how does a company like that run a profitable business, even if they can't actually predict the scope of almost anything that they're going to do? Well, they sell time, and they make sure that their margin on that time is consistent and healthy and accounts for all the costs that they need to cover. And then the game there is to basically try to make sure they get paid for all the time that their team spends. And as long as they do that, they have good margins. And so I know we've spent a lot of time in our industry as an agency industry kind of really shitting on time and materials billing, but there is a time and a place for it. And I think that, hopefully today we have a bit of a more nuanced conversation about where that time and place is and when it makes more sense to like really productize and use flat rates or value-based pricing. Like all of those things are awesome, but it's just a question of in what circumstances.
Yeah, I think that's actually a good direction to kind of go here to kick it off is, when does that make sense? And is it like a function of volume more so or complexity of project? Because, if you're doing similar types of projects at a high volume, probably don't make enough money to do everything bespoke. Whereas like you said, designing a bridge, that's a pretty big project. So is that one of the kind of levers there, or what does that look like?
So the way we think about this is a quadrant. We call this the agency pricing quadrant. And we can, if you'd like, I can send over some links in the show notes for people to go and get some visuals to help walk through this with, because we've written about it ad nauseum on our blog. But the basic idea is imagine a quadrant. So we'll start with the vertical axis of this quadrant. So imagine you're drawing a line up the middle of a blank page. At the top of that line, you have high value, and at the bottom of that line, you have low value. So that's kind of the first consideration is the thing I'm selling of high value to the client, or is it of low value to the client? And it's important that we're using the word to the client here, because it doesn't matter how valuable I think it is. It matters how valuable the client thinks it is, because they're the ones that have to part ways with their money. And generally, the way I think about value, there's a lot of things that influence it, but the two biggest ones are going to be, number one, our positioning, which really determines how many alternatives does the client perceive themselves to have as opposed to hiring us. So the example I use with this a lot is if my positioning is we are a graphic design firm. Well, I'm now competing with everything from Canva to, somebody in their office using MS Paint. Nobody uses MS Paint anymore, but that's the joke. Or IDEO, right? Like the most expensive design firm of all time. There's so many options that they could compare me to. But if I'm selling, for example, to a B2B SaaS company that has a really complex product, and my positioning was we help B2B SaaS companies communicate visually, like communicate complex products using graphic design. I'm still selling graphic design, but that positioning has really helped narrow the scope of the viable alternatives that they could compare me to. So that's an important factor is like, am I really narrowing my positioning to increase my perception of value, which really correlates to the level of certainty they think they have of hiring us and getting the outcome. And then the second thing to think about there is what is the relative value of the outcome to the client. So I could come to two different clients and say, hey, we could install these new graphic design assets on your website and it'll increase your conversion rate by 1%. Well, if I do $10,000 a month in sales or $10 million a month in sales, the value of that 1% is different to those two clients. It just is. So those are kind of the two main considerations when we're thinking about value. But of course, there's lots of other things. And that's step one is, are you selling something that is of very high value, has very few alternatives, has a massive impact on the business, or are you selling something that's kind of more of a commodity? And there's not a right or wrong answer. It's just about being aware of what situation you're in. So that's kind of vector number one on the quadrant. I'll pause there in case there's anything you want to double click on there, Dustin.
Yeah, no, I really like the way you're thinking about that because I'm just drawing comparisons to what we do, right? So like we create video testimonials. So if we played in the video production space, everyone and their dog does video production. Right. And we've seen that like on Clutch, you go there, there's, 15, 20,000 people. So we niche down, could charge a little bit more. And I think maybe bumped up that value where it's not as commoditized. So just to give a kind of a concrete example of something we're living, that makes a ton of sense thinking about it that way.
100%. And it's funny that you mentioned this because like I'm currently creating a case study with my internal video editing team. And so like coming to somebody like you and then you being able to say, hey, we've created literally thousands of these. We know what works. We have a process for it. These are the best practices. Like we have data that helps us show like, hey, when you do or don't do these things, this is how much more or less effective a case study is. The amount of thinking that I've had to do and the amount of guessing that I've had to do trying to coach my team on how to create a case study, and I'm just pulling this stuff out of my ass, there's a lot
Yeah.
of value in your expertise saying like, this is what we do. And we've done so many reps, more reps than I'll ever be able to do in my lifetime. And you get to also buy that experience by hiring us to do this very specific thing. Like that's pretty awesome.
Yeah, no, absolutely. So that's okay. The value or the value line makes sense. What about on the other axes? What's the alternative one?
So this comes down to the thing that we were poking at earlier, which like value, everyone's talking about value-based pricing, et cetera. The thing that nobody's talking about, but every agency owner knows inherently as a consideration is risk. And risk really comes down to, can I predict what it will cost me to do this thing for the client? Right. So on one side of that, so if you're drawing this line horizontally, on the right-hand side, you're going to write low risk. So this is stuff that like you can predict to within 10 or maybe 20% of the actuals, what it will cost you to get this thing done. So to your point, Dustin, something that you do a lot of over and over and over again, you start to develop a process, you start to be able to like really accurately predict how much time it will take to get things done, what kind of people are going to be required, what those people cost. That's great. That low risk work, you can start to arbitrage the low risk nature of that work to decouple time and money so that when you come in spending less time and you get more efficient on that thing, you can capture the upside. So that's one side of the equation. But what happens if you can't predict how much it's going to take, or the error bars around that are massive? Like it could cost me $10,000, but it could also cost me $80,000. And especially when you get into things that are, there's kind of three common examples of this. When the client doesn't actually know what they need and the scope is very nascent. So you kind of have to go in and discover what the needs are, what's going to work. So there's just an iterative process that's required. And so agile software development is a really good example of this, where it would actually be anti-agile to try and predict upfront exactly what you're going to do, because the whole point of agile is that you don't do that. You like do some work, learn, iterate, right? So you would not want to use a contract model that is like a fixed price or a flat fee and then deliver it in an agile methodology, because you'd literally be fighting against your own contract every 2 weeks when you have to rip the scope apart and rebuild it over again, right? It would be getting in the way. So that's one example when there's not really clarity on the scope, or the nature of the work is just inherently high risk. So for example, if the city of Baltimore comes to us and says, we need you to help us build a bridge, well, it's like almost impossible to predict exactly what it's going to take to build that bridge. And to try and even get close to that, you probably have to do several $1 million worth of work to just like go figure out how deep the water is and, you know, what's in the bedrock and what the wind speeds are. And like, there's so much information you're going to need to collect to even just like get some kind of assessment of what it's going to cost. So in situations like that, where it's just inherently risky work, you can't really predict it, or the error bars are so massive, those are high risk kinds of work. So we now have the quadrant. We have value up and down. We have risk side to side. So we'll start in the bottom left-hand corner. When you have low value, high risk work, that's when selling hours or time and materials actually makes a lot of sense, right? Mm-hmm. We sell the client time. The game is make sure we have enough margin on an hour of time and we get paid for the majority of the time that we spend. And then if things are changing or they're unclear, or, you know, it takes us a lot more or less time than we thought, at least we're still making a good margin on that time. When we have high risk, high value stuff, we still sell time, but this is where I call this abstracted time and materials. So we abstract away from the hour, either by going to larger time vectors, so days, weeks, months, sprints, and then we can also abstract away from individuals to cross-functional teams. So if you were going to hire me to build you a bridge, for example, I might say, okay, Dustin, this cross-functional bridge engineering team that is made up of designers and architects and structural engineers and physicists and project managers, they cost $20,000 per biweekly sprint. And we think that the first two phases of this build are going to take between 40 and 60 sprints. And then again, it doesn't matter if it ends up taking 80 or 90 sprints to get the work done, because you're paying for sprints and the game is prioritizing the backlog and focusing on the priorities every given sprint. So I can still, again, charge for time and be protected from the downside, but I have more ability to increase my margin because I'm abstracting away from the nuts and bolts and giving myself rounder edges to work with. So that's the high risk side of things. And then when you go to the other side, lower right-hand corner, you have low risk, low risk, low value. That's where flat fees work really well. Mm-hmm. So instead of me saying, hey, Dustin, it's $500 an hour for me to build you a website, I can say, hey, this website that you want is $5,000. and I might still make $500 an hour because I can get it done very quickly because it's low risk. I know what it's going to take, but it doesn't matter to you because you get a great value in terms of that flat price, and I'm taking on risk, which helps like increase the perception of value for you. And similarly, value-based pricing would be the low risk, section of the quadrant. And the only difference there is instead of giving you a price for the deliverable, so I'm tying the price directly to the thing that you're getting, I'm now tying it to the outcome. So if you asked me to build you a website, I wouldn't say it's $5,000. I would say, well, tell me about your website. How much traffic do you get? What's a client worth to you? How many clients did you get last year? How many of those came through the website? What's your conversion rate? Interesting. How much do you think a new website would improve that conversion rate? Oh, fascinating. Mm-hmm. This would add $10 million of revenue to your business next month. Do you think that would be worth investing maybe 10% of that upside in order to get that outcome? So it's a different and more nuanced conversation. And there is an extension on that, which is actually directly tying pricing to outcomes. So this would be like, oh, why don't you pay us a flat fee of $10,000 plus 10% of every additional client over last year's numbers that you get as a result of the new website. So it's nuanced and it's hard to do because you actually have to measure that. But that would be an example of, getting into value-based pricing. And those are where you really have an opportunity to dramatically decouple what it costs you from what you get paid and really increase your margins. But again, on that right-hand side of the quadrant, you need to be able to price the risk in, because if you don't, you could lose money and be worse off than if you just sold time. So that was a lot of me talking. I'm going to pause there, Dustin. That's the quadrant.
Yeah, no, I'm picturing in my head that makes a ton of sense. And I'm just thinking like the upper right, I've worked with outbound agencies where they, take a percentage of value of opportunities created, for example, and that pulls from there. The first thing that came to mind though is that bottom left quadrant. If I was an agency that wanted to scale, would I want to stay out of that bottom left? Because my initial take would be, I don't know about living down there.
Not necessarily. In fact, if you want to scale, that's one of the easiest ways to do it. It's funny because people say that you can't scale an agency on time materials billing, but then you go look at all the biggest consulting firms and agencies on the planet, they're all still primarily doing time materials billing, right? So what's going on there? And the problem that most people have is that they just don't have enough margin in their hourly rate and they don't keep their utilization rate high enough. So it's a different way of building a business. But if you think about it, the business model that we're in is labor arbitrage. So if I hire someone for 2,080 hours of their life per year in exchange for a salary of, let's call it $100,000, and I can expect to have 1,500 of those hours resold to a client at a certain hourly rate, and I know that I'm going to make, let's call it a 70% direct profit margin on that, which is roughly what it should be for that business to be healthy, then I'm incentivized to hire as many people as I possibly can, as long as I can resell that time to a client for that margin. And yes, we're limited in terms of we're not going to have an 80 or 90% margin like we might have if we were using value-based pricing, but we're also not going to end up with a 20 or a 30% margin like we might have if we were doing flat rates and we were constantly blowing through the budgets and constantly, see what I mean? So as long as the unit economics are sound, you can scale a business on any of these things. We really just have to consider what is most appropriate to the nature of the work that we do.
Yeah, no, absolutely. I do want to talk about some of those metrics that people should track so they have something to really take away and focus on. But one thing that I was thinking about here, more so I guess on the left side as well, is because you have to build in a little bit of buffer, right, to your hourly rates. What happens about a lot of people who are running their agencies not profitably, who come in and undercut you? Because wouldn't there be that risk slightly there as well? And then is that a function of value and positioning to balance that out?
Yeah, like it still comes down to value and positioning. And you also have to understand what game you're in, right? So if you're positioning yourself in a commoditized market on time materials, you're in the efficiency game. So if you're finding that people can come in and undercut you on pricing, well, unfortunately, that's the game that you signed up to play. So you need to then figure out how to get your hourly rates to be competitive, whether that's by getting much more efficient at what you do, whether that's by finding lower cost talent and figuring out how to do like geo arbitrage, for example, right? And that is a valid business strategy. We will be the most efficient operators in the market and we will win on price. It's a valid business strategy. But for most of the people listening today, it's probably not the game that they want to be playing. It's probably not going to be very fun to them. They probably don't have the skill set for it, right? But it's not to say that that's not valid and people haven't been successful doing that. Lots of people have been successful doing that. But I would say it's probably true that most people would not be having fun running that business, nor would they be successful. They're probably better suited for leaning into more high value type services, winning at a marketing, positioning, branding, strategy kind of game, as opposed to like a volume commodity game.
Yeah, especially as like getting in front of people has gotten easier with, the outbound spam cannons, and there's just a lot of ways to get your product at least in front of people. So I want to quickly touch on the actual metrics, because like going back to B2B SaaS, shoot for 85% gross margin, probably not achievable in a lot of agencies, depending on where they fall there. So what would be kind of a reasonable benchmark there?
So we'll differentiate between what we call direct delivery margin, which is what you would expect to see as a profit margin on a thing that you sell. And so here in the context of pricing, that's the place that we'll start. You want to generally set the floor at about 70% when you're selling something. So what that means is the agency gross income that you collect. And to define that for a moment, agency gross income is defined as all the money you collect from the client minus whatever passes through you onto external vendors. So as an example, if I sold Facebook ads and you paid me $10,000 a month, but I spent $8,000 a month on Facebook ads, that is a $2,000 a month AGI contract for me.
Yeah.
Right. So then the question is, what does it cost me to earn that $2,000 that I'm now getting to keep? And the answer should be less than 30% of that $2,000, or in this case, $600 in direct labor cost. So if I look at the hours that it takes my team to run your ads for the month, multiplied by the average cost per hour of those people, I want to spend no more than $600 to earn that revenue. And as long as I'm doing that, what that should mean is that I'm going to probably lose about 20% of that margin to what I call indirect delivery costs. So that would be the time on your delivery team that doesn't get utilized. They spend it doing personal development, time off, holidays, there wasn't work, so they weren't busy, etc. That's going to leave us at about 50%, hopefully, on the profit and loss statement. So that's the goal on the profit and loss statement, is to be above 50% gross margin on the P&L. And then we'll probably expect to have another 30% of that go to our overhead costs. So sales and marketing, acquiring customers, administration, facilities and rent if you have it, right? The important thing is that that all comes together at around 30%. And hopefully that leaves you with a 20% or higher profit. And of course, to the extent that you can increase your gross margins, you have the opportunity to have more net profit, and you have the optionality to invest more in growth, to pull more money out. So it all starts with, when you sell something, make sure you are aiming for at least a 70% gross margin, or direct delivery margin, I should say, and then that the rest can trickle through to the bottom line. And at a high level, that's kind of the most important baseline benchmarking that you can do.
Yeah, I like the idea of pulling out all the pass-through costs, because we weren't doing that. Now we are, and it makes our margins look a lot more realistic. So for example, when we film on-site, we have to pay a crew. Like there's a crew cost, right, to hire them to film. So pulling that out really helped us standardize it. So yeah, I like how you broke that part down as well. And then you mentioned, then you can kind of pull up and down. Do I want to grow? Do I want to extract more profit? And you can even be flexible based on a little bit on how the market is. Like last year, the market was rough. So we're like, let's stockpile some profit and be safe. Now the market is good. So let's spend some money and grow, at least in our space. So is that kind of how you think about it in an agency as well? Just being able to pull those levers up and down.
100%. And the big message that I have for people that run service-based businesses is that gross margin and direct delivery margin give you the optionality. If those aren't healthy, then the business is going to be happening to you, and you're just kind of going to end up with the profit that you end up with, and you're going to be fighting against your business all the time. But if those metrics are healthy, then you just have the choice, and you can choose to push the chips back into the table, take them off the table, stick them in a reserve for a rainy day. But that cash is available to you because the fundamental engine for profitability in the business, which is how efficiently you earn your revenue, is healthy. And without that, everything else is hard.
Yeah, absolutely. So one last question actually on the metric side. So I like the gross margin breakdown. The other thing us, and I'm sure a lot of agencies think about, is how much cash to stockpile for a rainy day. Like what percentage should you actually have there? And I mean, with how interest rates have been, at least you can get a good return by storing maybe a little bit more away. But curious how you think through that. Like, is there a minimum or some ratio?
Yeah, the general rule of thumb is, and this is not like my material. This is based on a lot of the financial firms that we work with that do a lot of CFO advisory. So the general rule of thumb here is you want to have 2 full payrolls in an operating account at all times. And then you want to have a cash reserve account. And then you want to have a tax savings account. So of course, tax savings, that's self-explanatory. Try to figure out roughly what you're going to need to pay in taxes and make sure you set that aside. Payrolls, we've covered that. And then the cash reserve is what you're asking about here specifically. Generally speaking, that's going to be anywhere from 3 to 9 months of operating expenses, with the majority of firms ending up on the lower end of that scale. Let's call it 3 to 5 months of operating income. And the way that you determine that is by basically looking at a lot of the same risk factors that an acquirer might look at if they were going to buy your business. So how much of your revenue is project-based versus recurring? What is your outlook on the economy looking like? How predictable is your sales process and pipeline? How dependent is it on, maybe like a single person in the business, like a founder? It might be looking at what kind of big investments or future investments do you have coming up? How much do you expect to grow? Are you going to have to buy a partner out soon, or your lease is coming due, or, so you have to basically look ahead and assess what is the durability and risk of our revenue and our income, and what is our outlook in terms of big cash investments that we're going to have to make in the business. And based on that, that'll help you determine if you should be on the lower or higher end of that cash reserve target, with the baseline generally being at about 3 months.
Gotcha. Yeah. So we threw a lot of numbers. Well, obviously, I know a bunch of the links you're going to send are going to help and going to outline this. But one last question here. So let's say some of the listeners here are probably starting agency or have a small-ish agency that they're looking to grow. If you had to pick just one piece of advice to give to them as they grow to keep in mind, what would that be?
I think the biggest thing would be make sure you have strong direct delivery margins and gross margins in your business. If that is true, everything else will be okay. And if you're just starting out and you're doing a lot of the work, when you're pricing something, we talked about direct delivery margin, when you're doing that calculation on what is the agency gross income that I collect from the client, what does it cost me to earn it? Think about what it would cost you to hire other people to do 100% of the work. So everything that you're doing right now, assign a value, an hourly value to that time based on what it would cost you to hire someone else, and make sure that your margins are strong, even with that being true. If you do that early and you maintain that over time, that will remove probably the biggest pain point that you'll experience as you grow the business, which is the constraint of money that holds you back from being able to hire people, solve problems, buy back your time, all of those things. So, besides the obvious advice that everyone will give you, which is figure out how to sell things consistently. Yes, of course, do that, but then also make sure that things you sell are actually giving you enough money to build a business on top of.
Yeah, I think that's a trap you can fall into as a founder, right? It's, this is so cheap, it cost me nothing, but it costs 80 hours of your time that week potentially, which is not free. So Marcel, that's great. I know you have a lot of resources, a lot of places people can go to learn all this. So let them know where they should go if they want to learn more.
Yeah. Well, first and foremost, we've put together a toolkit that you can grab at parakeeto.com/toolkit. It's absolutely free, and it will go much deeper on a lot of the stuff we've talked about today in terms of pricing, in terms of metrics, in terms of how to calculate these margins, and gives you lots of free resources, videos, cheat sheets to do all that with. So be sure to go check that out. We also have a podcast, which you can follow, and we recently released a course as well. And then a personal thing that I just want to talk about is that I recently wrote a book with 3 of my good friends, one of them being Dan Martell. It's called Software as a Science, and we just released it. And it kind of shares how we've been building a software company as a service-based business at Parakeeto. We kind of used the service model to help bootstrap the development of a SaaS platform, and all of the best practices, that we're learning through doing that ourselves and then coaching other SaaS companies through that organization. So feel free to go check that out. I'd be grateful if you did.
Nice. Awesome. So we'll include all those links. I'm actually going to check out that book because we're spinning up a little bit of SaaS stuff here as an agency as well. So Marcel, that was awesome. Thanks so much.
Thanks for having me, Dustin. It was a pleasure.
Thanks for listening to this episode. My key takeaway is just the concept of the agency quadrant. It's something conceptually, it's just a framework that helps it all make sense and tie it together. And my main thing there is that any part of the quadrant could work. So my initial thought, as you can tell in the conversation with Marcel, is, maybe I don't want to be bottom left. But he made a good point that the key is really just to be aware of where you are, because it'll influence your go-to-market, how you price, and all of that. And also maybe be aware of where you want to go within that quadrant if you do want to move eventually. So if you enjoyed this episode, hit follow on Apple, Spotify, wherever you listen to your podcasts, and I'll be back next Tuesday with a new episode.